Hey everyone, welcome back to Corporate Decoder, the place where we try to peel back the layers of corporate jargon and find the real story hidden inside those big official filings. Today we are diving into a company that is getting ready to, well, let's just say make a big splash. We've got a very interesting filing from Karbon Capital Partners Corp. A company that looks like it is gearing up for a significant public offering will be looking at their initial steps and what they mean for potential investors. And hey, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these filings even further. Alright, let's get into what Karbon Capital Partners Corp is up to. This filing is all about setting the stage for something big. Think of it as the company announcing they are opening their doors to the public market. They are essentially getting ready to sell shares of their company to you and me. They are issuing what they call units. Now, these units are not just one thing, they are a package deal. Each unit is made up of one share of their common stock, which they call Class A ordinary shares, and then a little extra something called a warrant. Let's break down that Class A ordinary share. It is basically a piece of ownership in the company. The important thing here is that it has a very tiny par value of just $0.0001. This is super common and doesn't mean much for us as investors in terms of its value, but it is a legal requirement. Now about that warrant, think of a warrant as a coupon. This coupon gives the holder the right to buy a Class A ordinary share at a set price. In this case, that price is $11.5 per S-share. The warrant itself is not a share, it is a right to buy a share later on, and interestingly, you get a quarter of a warrant with each unit. Meaning you would need 4 of these little coupons to get rights to buy one full share at that $11.5 price. This structure is often used by companies going public to make their offering more attractive. The key date here is the 10th of December 2025. This is when a lot of these initial agreements were put into place. It is the starting point for this whole public offering process. This document is what is called a Form 8. Think of it as a company's way of quickly telling the public and the government about important things that are happening that aren't part of their regular scheduled reports. It is like a breaking news alert for investors. So the company behind all of this is Karbon Capital Partners Corp. They are based in the Cayman Islands, which is a common place for companies to incorporate due to tax laws, but their principal executive offices are actually in Scranton, Pennsylvania. It is always interesting to see where a company says it is headquartered versus where its day-to-day operations are. Now let's talk about what is actually being registered and traded. They've got these units for sale. Remember the shares and warrants bundled together. These units will trade under the symbol KBONU on the Nasdaq Stock Market LLC. Then you have the Class A ordinary shares themselves. Trading as Karbon and the redeemable warrants, which will trade as KBONU, all of these are getting ready to be traded on a major exchange. The Nasdaq, this shows they are serious about becoming a publicly traded company. Here is an interesting note, they are identifying themselves as an emerging growth company. This means they are a relatively new company and are eligible for certain regulatory perks or extensions to comply with new accounting standards. It is a status that many newer companies aiming for growth will claim. This part of the filing is about a really important contract. It is called an underwriting agreement. Think of the underwriter as the middleman, a big investment bank, in this case Citigroup Global Markets Inc., or Citi. They are the ones who help the company sell its shares to the public. The company is agreeing to sell 30 million of these units at $10 per unit. That is a lot of units, and at $10 each, that is $300 million right there to start. Citi also has an option to buy even more units if they want to cover any extra demand, up to an additional 4.5 million units. The company will get $9.8 for each unit sold after what is called the underwriting discount, which is basically the underwriter's fee. This warrant agreement is the official rulebook for those warrants we talked about. It spells out exactly how they work, who manages them, and all the details regarding their exercise. It is like the fine print on that coupon. This letter agreement involves the company, its main backer called the sponsor, and all the top people at the company like the CEO and directors. It is likely an agreement about how these key individuals will conduct themselves and what their roles will be, especially during this transition to being a public company. It could cover things like lock-up periods where they can't sell their shares for a while. This investment management trust agreement is a critical piece for companies that are going public through what is often called a special purpose acquisition company, or SPAC. Typically, the money raised from the IPO is put into a trust account. This agreement lays out the rules for that trust, who manages it, and how the money can be used. Usually only for a business combination, or if the company needs to return the money to investors if a deal doesn't happen. The registration rights agreement is about allowing certain people or groups who already own shares to have those shares registered and able to be sold publicly. It ensures that their existing holdings can become easily tradable on the stock market. This private placement unit purchase agreement is another key part of the puzzle. The company's sponsor bought 890,000 units in a private sale. These are similar to the public units, but they are not sold on the open market. They are bought directly from the company by the sponsor. These units also come with shares in those quarter warrants. It is a way to get some early funding and commitment from the main investors before the broader public offering. And here is the big news from the 12th of December 2025. The company had its initial public offering, or IPO. They issued a total of 345,000,000 public units. This number includes that extra option that the underwriters took up. This means they raised a massive $345 million just from this IPO before some fees and costs. That is a huge amount of money to bring into the company. This section talks about those private placement units again. On the 12th of December 2025, the same day the IPO closed, they finalized the sale of those 890,000 private placement units to their sponsor. At $10 per unit, that is an additional $8.9 million. These private placement shares and warrants have some differences from the public ones. For example, they won't be redeemable by the company, and the shares won't have any claims on the trust account if the company doesn't find a business to merge with. This is pretty standard for SPACs, ensuring that the initial investors have different terms. This is about the people in charge. On the 10th of December 2025, several new people were appointed to the company's board of directors. These new directors are Jeffrey Zukowski, Joseph Manchin III, Sarah Morrison, Barpolis Patricia K. Kallorn, and Stephen Moore. Some of them also took on roles in important board committees like the Audit Committee and the Compensation Committee. It shows a strengthening of the leadership team as they get ready for public life. The company will cover their expenses and pay them for their work, which is normal. This is about the company's foundational documents. On the 11th of December 2025, they updated their official charter, the amended and restated Memorandum and Articles of Association. This is a legal necessity when a company goes public to align its internal rules with the requirements of being a publicly traded entity. This simply states that on the 12th of December 2025, the company put out a press release announcing the successful closing of their IPO. This is standard practice to let everyone know officially that the public offering is done and dusted. This is the list of all the supporting documents that come with this filing. There are a lot of them, including the underwriting agreement, the warrant agreement, trust agreements, and the various private placement documents. It is like the appendix to the main story. This is the underwriting agreement we talked about. It is the core contract with the investment bank that is orchestrating the sale of the company's shares to the public. This is the detailed contract that governs the company's warrants. It clarifies all the terms and conditions for these exercisable rights. This is the agreement for the private sale of units to the company's sponsor. It is a key piece that shows how the initial investors are involved. Now, looking at these results more broadly, Karbon Capital Partners Corp, as a company going public, is essentially at the starting line. They've successfully raised a substantial amount of money, $345 million plus an additional $8.9 million privately. This capital is typically intended for the company to then pursue a business combination, meaning they will likely use this money to acquire or merge with another operating company. The structure with shares and warrants is designed to give investors potential upside through the warrants if the company's future endeavors are successful. The clear risks involve the actual business combination itself. Will they find a suitable target? Will the market conditions be favorable for that merger? Will the acquired business be profitable if they fail to find a business within a certain time frame? As is typical with SPACs, they may have to return a significant portion of the capital to investors. Their current financial health as a shell company before a business combination is less about operating performance and more about how effectively they deploy this raised capital. The success hinges entirely on the strategic decisions they make in acquiring and integrating a real operating business. Alright, that is our breakdown of Karbon Capital Partners Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.